It's the disconnect that keeps me up, not the drop. I can handle a drop. I've traded through '08. I've traded through the flash crash. I remember when oil went negative. Volatility is just the price of admission in this game. But what happened over the last 72 hours? That's not volatility. That is a malfunction. If you pull up the chart right now, it looks like a crime scene. Silver down nearly 25% in what? 3 sessions? It looks like the world just gave up on the metal. If you're a technician, if you just trade the lines on the screen, you are shorting this with both hands. You're looking at that vertical red line and thinking the bottom has fallen out, that demand has evaporated, that the industrial story is dead. And honestly, if I only looked at the futures market, I'd agree with you. It looks like a liquidation event. It looks like capitulation. But then I tried to source 5,000 ounces for a client this morning. Just a standard allocation, nothing massive. And the premium wasn't down. The premium was up. The spot price is cratering, literally falling off a cliff, but the cost to actually get your hands on a physical bar is climbing. That shouldn't happen. That violates the basic physics of a functioning market. In a normal market, when the price crashes, it's because there are more sellers than buyers. Supply overwhelms demand. Prices drop to clear the inventory. That is not what is happening here. We are seeing the paper price, the price dictated by leverage contracts in Chicago and New York, divorcing itself completely from the physical reality of the metal. I'm looking at warehouse data that shows withdrawals accelerating during the crash. Think about that for a second. Price collapses. Usually, buyers step back. They get scared. They wait for the bottom. They don't want to catch a falling knife. But here, the big hands, the ones who actually take delivery, not the ones flipping contracts for a quick buck, they are draining the vault faster today than they were when silver was at its highs last week. There is a specific number, 36%. I'm going to get to that in a minute because it practically explains the entire crash, and it has absolutely nothing to do with solar panels or inflation or the Fed nominee. It was a rule change, a structural lever that was pulled in the middle of a night on a Friday when liquidity was thin. And what worries me isn't the price action. It's who's on the other side of this trade, because while the retail traders are getting stopped out and the algorithms are blindly dumping paper contracts because their math says sell, someone else is standing there with a bucket catching every single physical ounce that falls. This feels like a trap, a bear trap for the paper guys, and a supply squeeze for everyone else. If you are holding positions or if you are thinking about panic selling because the chart looks terrifying, you need to pause. You need to look away from the red candle for a second and look at the plumbing, because the signal is flashing red, but I don't think it means sell. I think it means the market mechanism itself is breaking. It starts with understanding the difference between price and value, which sounds like a cliche you'd hear on a motivational Instagram reel. But in commodities, it is a literal mechanical distinction. The price is what the screen says. It's the last trade executed on the COMEX. The value is what happens when you actually try to take possession of the asset. Right now, the people getting hurt, the ones bleeding out in this crash, are the ones who confuse the two. The traders, the hedge funds running trend-following algorithms, the retail guys who bout call options because they saw a breakout pattern on the weekly chart, they are being wiped out. And they're being wiped out because they are playing a game of leverage in a room where the house just changed the rules. I mentioned 36%. That's the number. Effective today, February 2nd, the CME Group raised margin requirements on silver futures. Depending on your contract here, it's anywhere from 15 to 36%. Now, if you're not a futures trader, let me explain what that actually means in plain English. It means the down payment required to hold your position just spiked overnight. Imagine you bought a house with a mortgage, and the bank called you on Sunday night and said, hey, by the morning, we need another 30% of the home's value in cash or we're selling the house. That is a margin call. And when that happens to a hedge fund holding 10,000 contracts, they don't have a choice. It doesn't matter if they love silver. It doesn't matter if they think silver is going to $100. They have to come up with cash immediately or they have to sell. And since liquidity is tight, they sell. So you get this cascade. The first guy sells to cover his margin. That pushes the price down. The lower price triggers the stop-loss orders of the next guy. He sells. Price goes lower. Now the algorithms kick in. blind mathematical formulas that see momentum down and automatically short the market to catch the ride. It's a feedback loop. It's a liquidation event. It has absolutely nothing to do with whether a solar panel factory in China needs silver paste today. It is purely a financial plumbing event. And that's where the narrative gets hijacked. Because if you turn on the financial news right now, they aren't talking about margin hikes. They're talking about Kevin Warsh. President Trump nominates Warsh for Fed chair, the market hears hawk. The market hears higher rates forever, and the dollar index rips higher. The computer sees the dollar go up, so it sells commodities. It's a reflex. It's an algorithm written 20 years ago. Dollar up, gold down. Dollar up, silver down. But here is where you have to stop and actually think, rather than just reacting to the red numbers. Does Kevin Warsh being Fed chair change the amount of silver required to build a photovoltaic cell? Does a stronger US dollar make silver conduct electricity less efficiently? Of course not. The industrial demand for silver is what we call inelastic. If you are Samsung, or if you are a major solar manufacturer, you cannot just substitute copper because silver got too expensive, or because the Fed chair changed. You need the metal. It's a chemical necessity. And this is the contradiction that nobody is talking about. While the paper market is puking, while these funds are forced to sell contracts they don't want to sell just to stay solvent, the industrial buyers are sitting there with their arms crossed, waiting. Actually, they aren't just waiting, they're stepping in. I was looking at the delivery notices this morning. We are seeing a divergence that we haven't seen since the chaos of 2020, maybe even further back. Usually when futures prices crash, the spot price, the cash price for immediate delivery, drops right along with it. They are tethered together. But over the weekend, that tether snapped. We saw a spread open up. At one point, depending on where you were looking, there was a $7 gap between the futures price flashing on the screen and the actual physical price being quoted by wholesalers. $7. That is the market screaming at you. It's telling you that the paper price is broken. It's telling you that the sell-off is artificial. If the sell-off was real, if the world really didn't want silver anymore, dealers would be slashing their premiums. They would be begging you to take the metal off their hands. Instead, they are raising premiums. They are widening the spread. They know that the paper price is a lie generated by a liquidity squeeze, and they are not going to give away their physical inventory for a paper price that doesn't reflect reality. This next part is where it stops making sense if you still believe the markets are efficient. You would assume that with a 25% discount on the screen, the warehouses would be filling up, right? Sellers dumping metal, inventory rising. We are seeing the opposite. We are seeing a run on the vaults. I'm talking about illegible silver, metal sitting in COMEX warehouses that is technically available for delivery, being moved into the registered category and then load out. It's leaving the system. Why would you withdraw silver when the price is crashing? You withdraw it because you don't trust the counterparty. You withdraw it because you see the paper market imploding, and you realize that if this liquidation cascade goes too far, the exchange might not be able to deliver the metal at these prices. So you have this bizarre, terrifying split-screen reality. On the left screen, the chart is in free fall. The media is screaming commodities crash, and the retail traders are panic selling. On the right screen, the vaults are being drained, premiums are spiking, and the industrial majors are quietly backing up the truck to buy everything that isn't nailed down. And the people who are misreading this, they are the ones looking at the left screen. They are the ones who think the price is the signal. They think the market is telling them that silver is dead. But the smart money, the sovereign wealth funds, the industrial conglomerates, they know the price is just noise. They know that a margin hike doesn't create more silver. It just forces weak hands to fold. And right now, the weak hands are folding en masse. We are watching a transfer of wealth in real time. It's not moving from the bulls to the bears. It's moving from the levered speculators to the physical accumulators. It's moving from the people who rent the metal to the people who own it. But there is a catch. There is always a catch. Because even if you understand this dynamic, even if you see the manipulation or the mechanics or whatever you want to call it, you are still exposed. Because the paper market market sets the price for everything. Your local coin shop, your ETF, your mining stocks, they all trade off that broken futures number. So even if you are right about the fundamentals, you can still lose money. You can be right and still get liquidated. That is the danger of a market that is driven by leverage rather than supply and demand. And what I'm watching next, what I'm waiting to see in the next 48 hours, is whether the physical market breaks the paper market or if the paper market breaks the physical market. Because one of them has to give. You cannot have a $7 spread forever. Arbitrage bots will close that gap eventually. The question is, does the paper price come up to meet reality, or does the physical price collapse to match the paper fantasy? Most people think it has to be the latter. They think gravity always wins. They think the futures market is the dog and the physical market is the tail. But I think the dog is sick. And in a minute, I'm going to show you a mechanism, something happening in the repo market completely outside of precious metals that suggests the paper market isn't just reacting to Kevin Warsh. It's reacting to a shortage of collateral that is so severe, they are selling the only thing they have left that is liquid. This isn't a silver crash. This is a dollar shortage masquerading as a silver crash. And if you understand that, you understand why the demand isn't collapsing. You understand why the buyers aren't backing off. They aren't backing off because they know the sale is temporary. They know that once the margin calls are met, once the leverage is flushed out of the system, the physics of supply and demand take over again. And the physics are terrifyingly bullish. But before we get there, we have to survive the flush. And the flush isn't over yet. The margin hike was effective today. That means the selling pressure we saw this morning was just the first wave of forced liquidations. There is a second wave coming. The funds that tried to hold on, the ones that met the first margin call by selling other assets, if silver drops another 2%, they get the call again. It's a meat grinder. And until the open interest, the total number of contracts outstanding, drops back to a sustainable level, the price is going to remain under pressure. So don't look at the price and think value. Look at the price and think liquidity. The price is telling you how much cash is available in the system. It is not telling you how much silver is available in the ground. And that distinction is the only thing that matters right now. This brings us to the mechanics of the trap. Because if you want to survive this, you have to stop asking, why is silver falling? And start asking, why do they need to sell silver? Those are two very different questions. Most people think markets are about opinions. They think a hedge fund manager wakes up, reads a report about solar demand, and decides to sell. That's not how it works. Not at this level. At this level, markets are about liquidity and collateral. Here is the mechanism that is actually driving this bus. It's boring, it's technical, and it's the reason your portfolio is red. When the probability of a Kevin Warsh Fed hit the wires, the bond market puked, yield spiked. When yield spiked, the value of the collateral that these big banks and funds use to secure their loans drops. Suddenly, the collateral in the repo market, the plumbing of the entire financial system, isn't worth what it was yesterday. The bank calls the fund, "You're undercapitalized, send cash." Now the fund manager has a problem. He doesn't have cash. He has assets. He has stocks, he has bonds, he has crypto, and he has silver. He needs to sell something now to satisfy that call. He can't sell his real estate. That takes months. He can't sell his private equity stakes. Those are locked up. He looks at a screen. What is liquid? What trades 24 hours a day? What can be turned into US dollars in a millisecond with a click of a mouse? Silver, gold, Bitcoin. They aren't selling silver because they hate it. They aren't selling because they think the industrial thesis is flawed. They are selling silver because it is the only ATM that is open. Silver is being punished for its liquidity. It is being sold to pay for sins committed elsewhere in the portfolio. This is what people miss. They look at the chart and see a bearish signal. Oh, smart money's getting out. No. Distressed money is getting out. There is a massive difference. Smart money sells at the top. Distressed money sells at the bottom because they have a gun to their head. And while the distressed money is puking up contracts to get cash, look at who's standing there with the bucket. This is the behavioral signal that nobody is talking about on CNBC. We know, based on flow data, that the buying coming out of Shanghai and Mumbai right now is not speculative. It is strategic. We are seeing sovereign entities, central banks, state-backed funds using this dip to accumulate. Russia, India, Saudi Arabia. They aren't buying futures contracts. They aren't playing the leverage game. They are buying the physical metal and moving it out of the Western vaults. Why? Because they understand the mechanic I just explained to you. They know that the Western financial system is selling paper silver to cover dollar debts. They see the price is artificial, so they are taking the physical asset at a discount. It is a massive arbitrage. The West is selling paper to stay solvent. The East is buying metal to stay sovereign. If you don't see that flow, if you only look at the red candle on your phone, you are missing the entire chessboard. You are reacting to the noise of the distress sale, not the signal of the accumulation. However, I want to pause here because it is dangerous to get married to a thesis. It is dangerous to sit here and say, I am right and the market is wrong. That is how you go broke. So let's look at the other side. Let's look at what would prove me wrong. What would invalidate this entire thesis? If this isn't a liquidity squeeze, if this is a genuine demand collapse, there is one place we will see it first: the warehouses. If the price crashes like this and stays down, and suddenly we see the COMEX inventory levels start to rise, if we see the registered category, that's the metal ready to be sold, start stacking up week over week, then I am wrong. If the premiums vanish, if I call a dealer tomorrow and he says, yeah, we have plenty of bars and we're selling them at spot, then I am wrong. If the solar manufacturers issue guidance saying we are cutting production, we don't need silver, then I am wrong. That is the kill switch. If we see inventory building up while the price is crashing, it means nobody wants the stuff. It means the industrial shortage story was just a story. I check those numbers every single morning. And right now, inventory is falling, premiums are rising. The kill switch has not been flipped. The data still says this is a paper event, not a physical one. But you have to watch it. You cannot just blindly stack and hope. You have to watch the inventory. Because if that trend flips, if the metal starts piling up, the narrative changes instantly. So where does that leave us? It leaves us standing at a fork in the road. And honestly, the next few weeks are going to be binary. There are two ways this plays out, and there isn't much middle ground. The margin calls continue. The liquidation cascade gets worse. The funds are forced to sell so much paper silver that the price goes to levels that make no sense. Maybe $18, maybe lower. If that happens, the miners shut down. They cannot pull metal out of the ground at that price. Recyclers stop selling. Supply goes to zero. At the same time, the physical buyers, the solar guys, the battery guys, the central banks, they clean out the shelves. They drain the vaults completely. In this scenario, the COMEX breaks. They declare force majeure. They say, sorry, we can't deliver metal. We will settle your contract in cash. If that happens, the price of silver isn't a chart anymore. It's whatever someone is willing to pay for a bar in their hand. The paper market dies, and a true physical market is born. That is the chaotic, explosive upside scenario. The margin squeeze ends. The funds stabilize. The selling pressure stops. Suddenly, everyone looks around and realizes silver is 25% too cheap relative to everything else. The industrial orders come in and hit a market with no sellers left. The price V-shapes. It rips back up to cover the gap, probably taking out the old highs because the short sellers get squeezed on the way up. This is the return to normal scenario. It's cleaner, it's less revolutionary, but it's still violent. Here's the problem. You don't get to choose which path we take. The market decides. And right now, the market is deciding based on how many hedge funds are underwater. We're in the middle of a forced liquidation. It's ugly, it's irrational, and it's the single greatest opportunity for mispricing I have seen in years. But you have to survive the volatility to get to the opportunity. Most people won't. Most people are selling right now. They are looking at the chart, feeling the pain in their stomach, and hitting sell to make the pain stop. They're doing exactly what the mechanism wants them to do. They're providing the liquidity that the big players need to exit their shorts. Don't be the liquidity. In the next part, I'm going to tell you exactly what I'm doing. Not advice, just my playbook. Because there is a specific way to play a market that is broken like this, and it involves ignoring the price on the screen and watching 3 specific indicators that tell you when the bleeding has actually stopped. Because it hasn't stopped yet. And if you step in too early, you get run over. But if you wait too long, you miss the divergence of a lifetime. So what do you actually do when the market is fundamentally broken but financially toxic? When the thesis says buy, but the chart screams you will lose your house? I had a client ask me yesterday, is this the bottom? I told him the truth. I have no idea. Anyone claiming they know where the bottom is on a liquidation wick is lying. When margin calls drive the bus, it doesn't stop at support levels. It stops when the last over-leveraged trader runs out of money. We aren't trying to catch the bottom tick. That's an ego game. We are trying to survive the crash to catch the recovery. Here is the playbook. First, rule number 1, 2, and 3, no leverage. If you're buying calls or futures right now, you are walking into a minefield. Volatility will stop you out even if you're right. I'm treating this purely as an accumulation event for physical metal and fully paid for mining stocks. But I'm not buying blindly. I'm waiting for 3 all-clear signals. Signal 1, the minor divergence. Usually, miners drop harder than the metal. Today, silver crashed 9%, but the junior miners, SILJ, only dropped 4%. That is the equity market sniffing out the nonsense. Smart money isn't selling shares down to the metal's implied level. If silver makes a new low but miners hold, that is a massive buy signal. Signal 2, lease rates. If physical silver gets tight, the cost to borrow it spikes. We are seeing flickers of this in London. If lease rates go vertical, it means shorts can't find metal to borrow. At that point, the physical shortage breaks the financial mechanism, and I am buying everything. Signal 3, the dollar index. This crash started because Kevin Warsh spooked the bond market, sending the dollar parabolic. You cannot fight a global liquidity drain. I am waiting for the DXY to hit resistance and pull back. Until the dollar calms down, the algorithm is in sell mode. Now, the risk. If this liquidity squeeze triggers a systemic credit freeze, a deflationary bust, then demand actually collapses. In a depression, nobody buys solar panels. If banks start failing, I pull back. But right now, I don't see a system collapse. I see a rate tantrum. I am positioning for the recoupling. Within weeks, the paper sellers will exhaust themselves, the margin calls will be met, and the world will wake up to the structural deficit. Solar factories and AI centers haven't stopped buying. The margin hike was a giant hand pushing a beach ball underwater, but hands get tired. Physics is forever. When they let go, the snapback will be violent. Selling physical silver now because of a paper margin call is capitulation. It is handing your wealth to the people who broke the market. I refuse to capitulate to a broken mechanism. I'm watching the spread, I'm watching the miners, I'm watching the dollar, and I'm keeping my powder dry for the moment the algorithm breaks. Because it always does. The only question is whether you will be solvent enough to act when it happens. This leaves us with one final question. It's the only one that matters when the screen is red. Are you betting on the paper price or are you betting on the physical reality? Because you can't bet on both anymore. I'll see you in the next one.